Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the show. Plenty to unpack today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. And how can you not be excited when so much is happening in markets?
Yes, a lot happening. We're going to look at why Nvidia has dropped 17% overnight. We're going to dive into our satellite portion of our portfolio and talk about our strategy there, and then close out with a new segment, $500 to $5,000. Can we 10 bag this year? Let's find out.
Yes. Now, the Equity Mates survey is still live. We'd love your input on what we should do more of, what we should do less of in 2025. The link is in the YouTube description or the show notes. So please give us a hand and help out. But I think, Bryce, without any further ado, let's get into the news of the day.
News and markets.
Now, most people will have heard the term, the name that has struck fear in the hearts of American technologists and investors, DeepSeek.
You reckon most people?
Oh, well, I don't know. Yeah, I
don't think so.
You don't reckon?
No.
Well, great. I'm glad you're listening.
Now they're going to find out.
We are going to explain it. But DeepSeek is a Chinese AI startup.
Yeah.
And we'll explain what it is, why it has rattled Silicon Valley so much, and the stock market effects of what they released, because it is the name that has struck fear in markets to start the week. But let's start with what DeepSeek is.
So DeepSeek is a Chinese AI company that they've released an AI model called DeepSeek R1. Now, the reason that Wall Street are quivering in their boots is because this R1 model is supposedly able to achieve similar levels of, performance as OpenAI and Google's AI platforms with far less compute power.
So DeepSeek was started by a guy called Liang Wenfeng. He's a Chinese hedge fund billionaire who runs like a quant fund in China, made all of his money there. Back in 2021, he started buying Nvidia GPUs for an AI side project he was doing. In 2023, that became DeepSeek. Now, China then got cut off from US technology, but he'd already bought a number of Nvidia GPUs.
Yeah.
And they say necessity is the mother of all invention. And while Meta and Oracle and OpenAI and XAI, Elon Musk's one, are spending tens of billions of dollars to buy the latest Nvidia GPUs, DeepSeek could no longer do that. And so they were forced to use what they have to create their large language models. And the scary thing for Silicon Valley is they were successful. And so here are some of the details. They used just 2,048 Nvidia H800s and $5.6 million to train a model with 671 billion parameters, which is about on par with OpenAI and Google's models. Much like the cutting-edge Google and OpenAI models, DeepSeek's model can learn and improve without human intervention. And so it launched last week. It's shot to number 1 in the App Store in the US and in China. And all of a sudden, it has called into question all of the assumptions around the required level of compute spend to achieve these AI outcomes.
Yeah. I mean, we've seen, almost a race to outspend each other between the big techs. And to your point, the assumption being that the more you spend, you get an equal return in quality or power of these models.
So a couple of words on how they actually achieved these outcomes, and then let's talk about the stock market reaction. There were a couple of things that they did to, I guess, reduce the compute. So, there were a few examples that have been floating around Twitter. Traditional AI models write every number to sort of 32 decimal places. They scaled that right back and said, let's just write it to 8 decimal places. So they just reduced some of the, I guess, the requirements of the AI. They also were able to teach their AI to read whole phrases at once rather than reading individual words, which apparently led it to be 2 times faster than Western models. They built this expert system. When we ask Gemini or ChatGPT something, it fires up, all of its parameters all the time. But with this expert system, it only calls on certain parameters when it is needed. It's the example that they're giving is having a doctor, a lawyer, or an engineer that you only call on when the question requires it. Now, obviously, we're not computer scientists, so we're not in the details, but the results are what matters and what we have here. So training costs have reduced from, the Western training cost for a model of this size, about $100 million, down to $5 million. GPUs needed in the West, 100,000. In this Chinese model, 2,000. AI, running costs, 95% cheaper. And it can run on gaming GPUs instead of data center hardware. So it's a step change, more efficient and cheaper. And that is what's led to this share market reaction.
Yeah, so overnight, at the time of recording, the NASDAQ was down about 3% with big falls in the sort of leading AI stocks. So Nvidia was down 17%. Broadcom down 17% and Oracle down 15%. Alphabet down 4% and Microsoft down 2%. So not as significant as some of the more targeted AI players. To be honest, I would have expected the market to be down further if one of the largest companies is shredding 17%. But I think other areas of the market have certainly held up. Pretty interesting time though, because we were kind of talking off air, and the more you think about it, now that you can understand how this has been done, all you need is the Western guys to sort of say, all right, well, we can now learn from that and apply something similar to better chips.
Yeah.
And then all of a sudden they're back in front.
Yeah, exactly.
So
it's okay, all of these innovations you made are really great ideas. Let's incorporate that, but use our overwhelming compute advantage.
Exactly. So not to say buy, hold or sell, but pretty interesting opportunity given how I guess the sell-off in some of these tech stocks.
Yeah. So a couple of quick observations as we move on from this story, but it's going to be one of the biggest stories of the year, I think. First of all, the arms race is on, and this should have always been expected. And America is going to return serve with these new Blackwell chips and the million GPU clusters that XAI is building and stuff like that. So this isn't the end of the story. This is just the next page. But second observation, unsurprisingly, Chinese AI comes with Chinese censorship. And so early users were quick to start asking it questions. On our Instagram, we published a video of someone asking something to the effect of what happened in Tiananmen Square. And it was really interesting. The AI model started answering it, and it got 3 or 4 lines into writing out an answer that explained Tiananmen Square, and then it flicked. So, and then it was sorry, I can't answer this question. Ask me something else.
Jeez.
So that limited. That is something. And then the final point is, I think, a point of irony. We've lived through the last 5 years where OpenAI has become less and less open, and it's gone from not-for-profit to very much for-profit enterprise. DeepSeek is actually open. It's open sourcing all of its research. Liang Wenfeng is already a billionaire, doesn't need to make any money from this, hasn't taken any outside investment for his company, and they are truly just open sourcing it all. And it's just ironic that OpenAI is still called OpenAI, but it's not open sourcing much these days. But I guess the race is on, and the biggest winners are probably going to be us as consumers and businesses who are looking to find ways to apply AI.
I know. We haven't even spoken about the OpenAI announcement over the weekend, Operator.
Yeah, the AI agent. Yeah, it's pretty cool, isn't it? Yeah.
It's happening so fast. If you haven't heard of it, look up Operator and how it will change the way that you interact with your computer. I think, very, very quickly.
AI agents are going to be the buzzword of 2025 in AI. And rather than asking AI questions, you'll now be able to instruct AI to do things.
Yeah.
Book these flights for me, negotiate a better rate with my electricity provider.
Bali.
Yeah. It's no longer asking ChatGPT to design the holiday for Bali. It's now asking it to actually go and make those bookings for you.
It can fully interact.
Or sit on hold with
buy me Taylor Swift tickets.
Yeah, exactly. Yeah.
Easy.
Yeah.
Incredible stuff. You do have to pay $200 a month for the pro version of ChatGPT to get access.
That's only until DeepSeek create one at 1/30th of the cost.
Also at some point, what's the cost of your time? Like if that's gonna free up administratively you 10 hours a week.
Yeah.
Like
answer all my emails.
Yeah, literally dead. I don't want to open my emails, answer them all. It will get to that.
No, it's gonna get to a point where it's agent on agent.
Yeah, 100%. Yeah, and you're just managing
And then we're going to start rocking up to meetings that have been booked by our AI agent and meeting people who have also been booked by their AI agent, and no one's going to know what the meeting's about.
We'll have avatars talking on our behalf. It's going to be wild.
All right. Anyway,
wild.
If you want to keep up to date with this story and these developments, make sure you're subscribed wherever you're watching or listening, because we're going to be covering it throughout the year and beyond here on Equity Mates. But Bryce, there's more going on in the world, so let's get to that. All right, Bryce. Well, given this is our first week back to regularly scheduled programming, and we know there are a lot of new equity mates who are joining the community, we wanted to continue to take the time to explain our investment approach and why it works. On Monday's episode of the podcast, we explained our core and satellite philosophy, and we spoke about the core side of our investment portfolio and spoke to some of the numbers and why it works. In this segment, we want to then talk about how we approach our satellite investing. So this is the portion of our portfolio that we're trying to beat the market, as opposed to our core where we are just taking the market's average return. And you can go and check out that episode if you want to hear that in a little bit more detail. So let's start with our satellite portfolio, what we're looking for, and maybe we'll talk to some of the examples in our portfolios as we go.
Love it. All right. Well, it's probably worth starting with what our criteria is when it comes to looking at small caps. Not just small caps, but you'll understand why small caps is on my mind later on. But when it comes to our satellite companies.
Yeah.
So there's kind of four broad criteria that we use. The first one being that we want a company that has an awesome product or service that their customers absolutely cannot live without. Then we want to figure out if that enables them to generate sustainable, long-term, above-market profit. Turn that product into cash.
Yeah.
And then with that cash, reinvest it back into the business in ways that create more value for Ren and I as shareholders. And then underneath all of that, can we buy that company at a reasonable price?
Yeah. And I think if you unpick those four criteria, you can think of plenty of companies that meet some of the criteria, but not others. Like there's a long history of companies that make a great product or service, but didn't make good money from that.
Yes.
A litany of tech companies that were never profitable. Every company in the media space really satisfies a customer's want or need, but doesn't make super normal profits from it and doesn't really have a moat. That's probably the best example, I think. And then there are plenty of companies that are able to make above average profits and have that moat, that sustainable competitive advantage where they can defend those profits and continue making those profits for years to come, but can't reinvest those profits in really productive ways. And for me, probably the most salient example of this is Australia's Big Four banks.
Yeah.
They have maybe not satisfied customers, but they've got huge customer numbers that aren't going anywhere. They make great money from those customers, but their ability to invest in new business lines or acquire other companies is constrained by the size of the Australian market, by their history of trying to go offshore, well, Australia's history of trying to go offshore, and, competition and regulatory concerns. And so they're kind of captured in this place where they pay great dividends. They sometimes buy back stocks, but it's like that their path to doubling their market caps perhaps isn't as clear as some other companies.
Yeah, first that came to mind for that was Telstra for me.
Oh, okay.
Like a company that, incredible market share, profitable.
Mate, have you seen their big AI investments?
But awful track record.
Yeah.
Of,
new things. Oh, God. Yeah. If you want to do a deep dive, look at Telstra's M&A history. It's not pretty.
It's not pretty. Yeah. No, it's not pretty.
And so, like, both of those examples that we gave are companies that will grow at like GDP plus. They'll grow at the rate the Australian economy grows, plus maybe a percentage point or two from like business efficiency gains. But yeah, they're not really the long-term compounders that we're looking for.
No.
And because that is the name of the game when we're personally looking for individual stocks in our satellite portfolio, it is those companies that we can buy and hold and that can grow at, 20% a year for 20 years.
Yeah.
That's the recipe for building real wealth in the stock market.
Yeah.
You can make money trading and power to you, but for us that's doesn't make as much sense as finding the next Amazon or whatever the company is. They're the ones we're looking for.
Yeah. With that said, it's probably worth taking a look at some of the positions in our portfolio against those criteria.
Yeah, so one company that I think illustrates this, although can't actually be bought at a cheap price now, is my largest individual stock holding. It was actually my 2023 stock of the year. For people that have been on the journey with us for a little while, they would know this stock. It's Axon Enterprise.
Yeah.
Axon, their history is in making tasers and trying to make non-lethal forms of weapons. Non-lethal weapons for police.
Yeah.
But why I think they're really interesting is they are the market leader in police body cameras, and they also have an associated software platform, evidence.com. And so in terms of those four criteria, make a great product or service. Well, body cams are not only a product or service that are highly sought after and in demand and, to be honest, required by legislation by a lot of police departments, but then evidence.com has just made collecting evidence a whole lot more efficient.
Evidence.com.
I know. We can talk to some of the network effects that creates and some of the reinvestment opportunities that it has led to in a second. Above market profits. Well, it's highly defensible, legislated use of body cameras in many cases. But for me, it's one of the most powerful network effects in existence, because as more and more players in the ecosystem use evidence.com, so it started with police departments and then prosecutors and then courts, and now it's like entrenched in particularly the US justice system. It's really hard to create a competing platform, and all of the information that's already on the platform and all the cases that are using that platform that are, in the process of moving through the legal system, it's really hard for a competitor to rip that away.
Yeah.
So then it becomes a reinvestment opportunity. Sure, maybe you make body cams, but, are you just in a constant race of replacement cycles of body cameras as they break and some platform subscription revenue? But there's a couple of really interesting opportunities. So one is to expand beyond the US. I feel like we're only going to see their technology used more in policing departments everywhere. But the really cool thing that they've launched at the end of last year, which I want to talk about, and part of the reason why I picked this company, is they are using AI. Like every company is using AI. They've launched this product called Draft One. It now takes police body camera footage and audio. I think it mainly uses the audio, and it writes police reports.
So good.
With AI, or like the first pass of them with AI.
Yeah, and if you've ever seen, I'm a chronic watcher of British cop shows.
Yeah,
and you don't want to be the new cop first cop on the job stuck with the paper reports.
No one wants to do the reports.
No.
Yeah. And so like some of the numbers are, it saves like, hours of police time each day writing these reports, and police departments are 30% more efficient and stuff like that. And it's like, oh, this is a great use case of AI.
Yeah. Nice.
Yeah. So reinvestment runway. But then the final criteria, and one where it doesn't tick the box, it's expensive. So when I pitched it as stock of the year, and just before that, it was kind of at like a 50 price to earnings, which is still pretty more on the expensive
spicy,
side.
Yeah.
It's now in like the 150s.
Wow.
Yeah. So it is making me think about.
But if the earnings increase.
Yeah. It is making me think about taking some of my profits off the table.
Okay.
And this is probably where I get really stuck as an investor, and something that I'm trying to work through in my head. I reckon about half of the experts we speak to, people like Luke Larrative and some of the more active fund managers are like, what would say, you've got to sell. Take your profits. What are you doing?
Yeah.
You can always buy back in later. But then some of the more longer term compound focused fund managers will say,
the biggest mistake I've ever made is selling.
Yeah. Amazon always traded at a 60 to 80 price to earnings, but like the biggest mistake would have been to take your profits off the table rather than just let it ride.
Yeah.
And I actually don't know which camp I fall in. And I think this is a real test case for me, because ask me one day and ask another day, and I'll go back and forth on this.
My kind of view on that is the more active short term. It's like they would say take your profits, because it feels like they're much more opportunistic in the short term with the stock. Like this is a 12-month play. We reckon it's going to be 60% up 60%. If it is up 60% in 12 months, that was our thesis, we're out. Whereas with the Amazons or whatever, and to our four criteria, it's like, this is the criteria. As long as it matches that and this thesis stays, it doesn't matter how expensive it kind of gets. Do you know what I mean?
Yeah, I know what you're saying.
Yeah.
I am probably right now, I'm probably leaning towards the King Solomon split the baby in half.
Yeah.
Which is probably neither camp would be happy with that.
No.
But I think taking some of my profits off the table, reweighting it in my portfolio so it's not as big a position, just because it's run so hard, is probably where I'm going to go.
Fair call.
Yeah. Anyway.
Fair call. Nice. Great criteria. Great example.
What about you? Let's work through that.
Well, if we're keeping biggest satellite position, then mine is Alphabet. And so a lot of these are pretty obvious. If we start with makes a great product or service, obviously incredibly dominant search engine.
Yes.
That I think 99% of people listening would be using, potentially going to ChatGPT, but nonetheless, very dominant. Huge digital advertising platform. But then beyond that, they've got YouTube, which we know is the second largest search engine in the world now. They've got Google Cloud, Android, Google Workspace, just a suite of products that have infiltrated or penetrated various different markets. That allows them to generate a fair amount of revenue across various different streams. And the margins are pretty healthy. I've got some here. So their gross margin's 58%. Their net profit margin is 28%. That is a little bit lower than some of their tech competitors, but still 28% versus some of the examples that we were giving before does allow them to take that cash and reinvest it. And that's where it gets interesting for Alphabet, because they're making significant investments in AI, machine learning. We've spoken about Waymo, their autonomous vehicles. They're also playing in the biotech space. So plenty going on, and they're constantly, even the investments, even that cash and what it's allowing them to do to invest in data centers and this race for AI is pretty incredible. But then the most appealing thing for me, Ren, is actually the final point, which is buy at an attractive price. It's currently trading at a PE of 25. And so when you look at that compared to the other big tech giants, it's relatively cheap. You will look at it in terms of S&P 500, again, relatively cheap. So given the growth opportunities, its market dominance, it does feel like it ticks the box on an attractive price at the moment. I just want to actually put some numbers to the return on invested capital as well, or the ability to reinvest, and compare it to Telstra. So Telstra's return on invested capital is 4%.
Okay.
Alphabet's is 32%. I think, 32.5%.
Nice.
So what that actually means, if you've just joined us, it means that for every sort of dollar that is reinvested back into the business, Telstra can expect 4 cents in additional profit, whereas Alphabet can expect 32 cents. So it's pretty incredible, and you can understand why that becomes an important a part of the thesis that a lot of investors look at is how much profit can I get back from these guys reinvesting money back in.
Yeah. As we look for individual stocks on this podcast and in our individual portfolios, that's what we're looking for. You know, the companies that can make a great product, can make good money out of that product, and then can reinvest it either in expanding that product, you know, new markets, new customers, or into adjacent markets or with new products. And then finally that we can get it at a reasonable price so we can make a good return.
Yeah.
And conceptually, it's not hard. Like that feels like it's overly simplistic. But I think the thing that we've learnt doing this podcast over, 8 years now, the complexity of your investment philosophy isn't the determining factor in how good an investor you are. It's the work that you put in to actually find the companies that meet a pretty simple investing criteria is why investing is hard. And that's where the money's made. So unfortunately, you got to do the work.
Yes. So we're going to be unpacking our watch lists over the coming year and doing a bit more content around the companies that are matching those criteria, or some that might match a few, and they'll stay on the watch list until they match all 4. But stick around, because after the break, we are going to be trying to turn $500 into $5,000 in a new segment. That's it. We're going to try and 10 bag. Stick with us. We'll be right back. Welcome back to Equity Mates. This is a new segment called 500 to 5,000, where over the next 12 months, I'm going to endeavor to turn $500 into $5,000.
Yes.
I'm going to try and 10 bag.
Yeah. Now,
very challenging.
before the break, you said we're trying to do it, but I get the sense that this is a Bryce Lesky personal challenge.
Oh, so
you're
more than welcome to join me.
I'm
happy to do this together.
No, I'm happy to. I'll just commentate from the sidelines. Yeah. So $500 into $5,000.
Yes.
What's give us the backstory and then talk us through how you're going to do it.
The backstory was me just looking at a number of companies last year that, like looking at Zip, for example, that almost did 10 bag. I think it was up 900 and something %
in a year.
Jeez. Yeah. I've always been interested in like the momentum trade. And I think for me, I know we've just spent time talking about our satellite portfolio, but a small part of my satellite portfolio, I want to start exploring different strategies to try and recognize stocks that have a fair chunk of momentum early on and see if you can sort of ride that momentum.
Yeah.
Because I always look back at the end of the 12 months and go, you know, how did we miss that stock that was, ripped 600%.
Especially Zip. The reason we missed it is everyone was writing it off. I am just having a look because, you're right. Between October 2023 and today, it's up 996%.
Exactly.
Yeah.
And so it's like, what can you put in place in your... And the story there makes sense. Like, it became profitable. Like, the turnaround story was all there. It sorted itself out.
Yeah.
And then the market responded. And so it's like, what can you set up in your investment process? It's kind of like we've just gone through our criteria, but what's the layer above the criteria to find the stocks? You know what I mean?
Yeah.
And then you kind of apply that criteria to it.
Well, I actually think it's a completely different exercise. It's like, I don't think you would say Zip meets this criteria. I don't think you would say Zip is, I don't think, and, people might disagree, but it has like a long-term defensible business model that can allow it to continue to make supernormal profits. I think it will constantly be competing with a lot of other credit providers where there's not a lot of barriers to entry and there's not a lot of customer loyalty.
Yeah.
And so I think like the investment process for this is different to that.
Yeah. That's true. But either way, I don't have like a
I don't think Zip would ever win.
A funnel.
Zip would never win in like a quality compounders filter.
No,
Zip would have sat in like a turnaround filter.
Exactly. Yeah. And so for me, that's what I want to try and use this segment for, is to try and force myself to have a process that I can try and recognize some of these companies early in that turnaround process. Because if you can recognize them early, then you can do the work from there to try and, I guess, get on board with the journey.
Yeah. Well, if you recognize them, then you just have to buy them.
Yeah. Well, that's the challenging part, because there are a lot of opportunities. So it's then filtering out. So
is it? But it's not just turnarounds, is it? Or is it just turnarounds?
No. So I think for me, this is about any stock that I think is going to get me to 10 bagging over the next 12 months.
Okay.
Yeah. It doesn't have to be turnarounds, but turnarounds is an obvious starting point.
Yeah, so why don't you just go mining explorers and biotechs?
No. So firstly, let's actually put some numbers to this, because 10 bagging, it's quite challenging, obviously. I need to average monthly growth of 23% between February and December. February being now is when we're going to start the challenge.
Yeah, but you're not going to do it by doing 23% consistently.
No, but that's the numbers though.
Okay, yeah.
That just puts into perspective what I need to get to.
Yeah.
Sure, 1 month I might do 0 and then I'm in a world of trouble. The 1 month I might do 50%.
Yeah.
And then, but I need 23%. So I need to more than double every 3 months.
Yeah.
Which is challenging. So 500 to 5,000 effectively every 3 months need to be doubling.
Yeah.
Tricky. So how am I going to do it? I think firstly what I will do is any investment that is accessible is in play.
Okay.
And I think I want to be playing predominantly in the small cap part of the markets.
I would think so, yeah.
I will be saying that Bitcoin is on the table because I personally invest in Bitcoin.
You're not going to 10x your money on Bitcoin this year?
No, I know.
Okay.
But I might 23% 1 month.
You might, yeah. Yeah.
So you know what I mean? I'm going to be quite active here. I don't think I'm going to... It would be wild of me to choose one stock now and just sit on it for 12 months. Do you know what I mean?
Yeah, okay. Are you going to pay brokerage?
So I think the platform... if I'm going US, I'm going to need to do it through Superhero because it's the cheapest of brokerage. If I'm doing Aussie, it'll probably be BetaShares Direct because it's 0.
What about Sharesies?
I can look into Sharesies because I can't quite remember what they are.
Well, if you want to, you could go like a Moo or something.
Nah. Nah. Stick to what you know. Stick to what you know. I don't want to stick to what you know. But you're right. I want a platform that is low cost and that I can easily get out of as well. I don't want to have a 3-day wait on transferring cash in and out. If I need to get my Bitcoin from SwiftX to Superhero, I want to be able to do that pretty quickly.
Yeah.
Because I feel like, there's going to be a lot of activity here. What I won't be doing, shitcoins, off the table.
Okay,
I don't know enough about it. If you have some opportunities and ideas, send them through. We might do them off air, but I'm not going to be doing it as part of this.
Yeah. It doesn't feel like it's in the spirit.
It's not in the spirit of the game. Yeah. I'm not going to be doing no gambling, no CFDs, and no external leverage, not going out and taking out loans to try and boost my returns here. I will be looking at leveraged ETFs though, because there's some interesting opportunities in that space. Three times leverage. I'm
so curious. You've only got $500. You're not gonna.
Yeah, but if you're trying to do 23% a month, it can be done.
Okay,
it can be done.
I'm excited.
Yeah, me too. So
I'm also excited that I get to spectate.
Yeah, well, you're in on this. You're the other half of equity, mate.
Yeah. Okay. Yeah.
So what I think we need to consider is
you need to consider.
I need to consider things like concentration. $500. If I'm going to spread $100 over 5 investments, I don't think that's the way to do it.
No, definitely not.
I think it's either 250 by 2 or just all in 500 and then see how we go from there. So high concentration. If we're looking at stocks, I'm going to be interested in and trying to build screens for rebound stocks or oversold stocks. Mm-hmm. One that comes to mind right now that I think as of today we'll probably put the money in is Nvidia. Not small cap, but down 17%. I could see a scenario where market thinks overreaction and literally in the next 5 days it's up 6 or 7%.
Yeah.
That's not out of the question.
Yeah.
But I want to try and build some screens that give me the same scenario, but in the smaller end of the market where the rebound or the oversold is probably a bit more aggressive than a mega tech company.
Yeah.
Similarly, do a bit of work on breakout stocks. So they're those stocks that have kind of hit the all-time high, but have done so with a fair chunk of momentum and volume and show indications of going further. So a bit of work to be done there. Some other ideas around leveraged ETFs. You can get some pretty spicy ones over in the States. So I'll have a look there. And then, of course, Bitcoin and crypto.
Okay.
So that's kind of the do's and the don'ts and what I'm thinking. I will be setting up some screens, as I said, because I think for me it's about building that funnel. I'll make sure I record as much as I can or notate a lot of the work that I do off air so that when we come back on, we can discuss what's been done, investments that have been made.
Yeah.
Because I'm not just going to wait till every time we come on the show.
You should just record yourself on mic and then we can package it up.
Yeah, I can do that.
Yeah.
So if you have any ideas on how or what we can invest in to 10 bag, we know the numbers. We need to double our money every 3 months.
You need to.
I need to. Starting from now, 28th of January is when we're recording. We kick off in Feb. But I think to get the ball rolling, Ren, I can't have my cash sitting in a brokerage account, cold hard cash.
Yep.
That's the worst thing that could happen. So I'm going to put it into Nvidia.
Okay.
And go from there.
Yeah, nice.
What are your thoughts on that?
I think that makes sense. I feel like people, so yeah, as you said, we're recording this 28th of Jan. It's a Tuesday. We've just come off Monday's trading session in the US when Nvidia was down 17%. I get the sense that it'll rebound today because this seems to always happen. There's a panic and then there's a bounce. The question is then does it fall again? But yeah, if you were in and out in a day, you'd probably be okay. But by the time this podcast comes out, we'll know if what I've just said was correct or not.
So yeah, as I said, please contribute. Join us in the Facebook. Send in your ideas. Mr. Beat Up will obviously have a few ideas as well because he's certainly focused in that rebound space. But
it's funny. This episode has just been a roller coaster of, well, first of all, the news of the day and what's been happening, and then we roll into like what we're looking for in terms of like long-term quality compounding stocks. And now it's like, all right, Bryce is now going to try and like go balls to the wall and take all the risk possible and try and make as much money in a short time as possible.
Yeah, I think to be fair, like it's a small chunk of change. But for me, it's actually the learning process that I want to go through, that I've wanted to do it for a while. And I think you've kind of known that, is just get a sense of this whole like technicals thing.
Yeah.
Like,
for
is
context,
there anything to it?
For newer listeners, probably like 4 years ago, you did like you had a brief technical phase.
Yeah.
You read like one book.
Yeah. How to trade like a stock market wizard.
Yeah. So we're back.
We're back. It's always in the back of my mind.
But back then it was more charting. Now it's more, I guess, technical indicators of like momentum and stuff like that, rather than trying to draw patterns on charts.
Yeah.
So you've grown up a bit.
Yeah, well, we'll see. We'll see. So stick with us as we try and turn 500 into 5,000 over the coming 12 months. But that does bring us to the end of our today's episode. Thank you as always for tuning in. If you love what we do have a big favour, and that is two big favours actually. A, complete the community survey. There'll be a link in the show notes. If you complete it in full, you will go into the running to win $500 cold hard cash, in which you could probably try and turn it into 5,000 alongside us.
What about this? If someone wins the $500, they can opt in to co-invest with you and you manage their $500 for them.
Deal. Okay. Deal. So yeah, by completing the survey.
I don't know what the licensing requirements are there, but
we'll work it out. But also, if you could please leave a rating and a review on your podcast app, it does really go a long way to help us get in front of new Equity Mates listeners to help them on their investing journey. But as always, Ren, a pleasure to chat, and we will be back in tomorrow's episode unpacking our spending and investing strategy. Bit of a deep dive with Pocket Smith, so make sure you tune into that.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.